Good morning, everybody. So today we're March 5th, and the issue I want to discuss today is depreciation. So one of the questions that I'm asked more often than not is, should I take depreciation on my rental property? Well, unfortunately, it's not a yes or no answer. It really depends on the circumstances of the client, as well as the client's preferences. So let's just start with the benefits and why I, as a professional advisor, would more often than not recommend that a client should take depreciation. First of all, we have the concept of the present value of money. So if you recall from your statistics classes back in CJEP or perhaps in university, the concept is that a dollar today has more value than a dollar in the future. In essence, because money loses its purchasing power over time, if you can take a deduction today, that refund will be worth more than if you have to include that deduction in income in the future. So what do I mean by that? First of all, depreciation is a temporary expense. What it means is that you get to take a percentage of the value of your building and take an expense against it. But when you sell the property in the future, you have to take that depreciation back into income. This is the concept of recapture of depreciation. Many people are not comfortable with this concept because they say they don't want to have to pay tax on that recapture. But when you think it through, you're getting a deduction today and you're saving taxes, and you're going to pay tax in the future. It's just a timing issue. So from a purely mathematical perspective, using statistics, it is almost always to your advantage to take depreciation and to save taxes today. That dollar in taxes that you save today is worth more to you than the dollar in taxes you'll pay back in 5, 10, or 15 years. Secondly, you have the possibility of saving penalties and interest. I had a client who came to me last week, and he's a non-resident and rents a rental property, didn't file the tax returns he was supposed to file, and 2018, 2019, and now 2020 are late filed. So we did his 18 and 19, and of course he owed income tax because he didn't have enough expenses to offset all of his income. He had a few $100s of taxes to pay, as well as interest and penalties that were going to be added on. I informed him that I should take depreciation, and he was pretty adamant that he didn't believe in depreciation because when he sold the property, he wanted to maintain the full proceeds. I wanted to explain to him how much he was going to save in taxes by doing it, and when he realized that it would be to his advantage, he says, you know what? You're the tax professional, do what you think is best, and I did, and we claimed the depreciation. So in that specific situation, despite the fact that he didn't want to take depreciation, he realized it was to his advantage. So that's a big motivating factor. So whenever we're dealing with late file taxes, depreciation is always something that's on the table. What are the cons of depreciation? Well, first of all, when you take an expense, you take it in as an ordinary expense, it's not a capital loss. When you take it back into income in the future as a recapture, it's ordinary income. So if your tax rate is 50%, you pay tax on that recapture of 50%. So if over the life of the property, each year you took, let's just say, $2,000 of depreciation per year for 10 years, for a total of $20,000. So every year, based on your tax rate, you save taxes on a $2,000 deduction. When you sell the property, the whole $20,000, $2,000 per year times 10 years, gets added up and dropped in one lump sum in that year. What could happen is, since we have a sale of a property and you have a big capital gain, which could be in excess of $500,000, it can push you into a higher tax bracket for that year. So in essence, you're paying back more in income tax than the deduction you got. Nonetheless, it's almost always the case that when you factor in the time value of money, and you're going to hold the property for 5, 10, 15, 20 years, it's to your advantage to be able to take the deduction each year. Also, don't forget that when you sell the property, you come into a huge amount of cash, and that's easier to use to pay the income tax. In other words, you've got the money to pay the income tax, you're not scrounging for it, so while it may be a little bit less palatable to have to pay the tax, you have the means to pay the tax, and that is a very, very big situation. Another thing we have to factor in is how much depreciation to take. So depreciation is a formula based on what we're going to claim. But we're not required to take the full amount. We can pick and choose how much we can. Just as a tangent, for anybody preparing U.S. tax returns, that is not the case in the U.S. In the U.S., depreciation is an obligation, not an option. And if you don't take it, the government will consider that you took it, and you may have a double tax situation. Coming back to Canada, so let's assume that you can take $2,000 of depreciation, and you could lower your income from argument's sake, $20,000 to $18,000 of taxable income. So you would say this is a good thing. Perhaps. You may have charitable donations that are due to expire, because charitable donations can be carried forward for a certain number of years. So we have to factor in all of the credits, because you may lose donation credits, or you may lose child tuition credits, or you may lose some other credit because you brought your income too low and you don't need to use it. So again, this is why we recommend that you have a professional prepare your taxes, because it's not about putting numbers in a tax return, it's about understanding the impact of every little decision you take. Sometimes having more income is actually to your advantage for a lot of reasons. So now, how do we calculate depreciation? Well, the standard rule is you take 4% of the value of the building and you can deduct it. And it's a declining balance, which means the first year you would take 4%. Well, in fact, you only get 2% because there's a half-year rule in that first year. And what that means is that the first year you only get to take half the depreciation because you would have acquired the property during the year. And rather than say, well, you took it in January, so you could take 12/12ths, or you took it in July and you could take 6/12ths, or you took it in December where you take 1/12 of the depreciation, the government of Canada said, you know something, we'll just get everybody a half-year rule. Once again, for those doing U.S. taxes, this is not the way it works, and the rules are much more complex and detailed. Coming back to the Canadian rules. So you buy a property for $200,000, but you know you can't depreciate the land, which is a non-depreciable asset. You can only depreciate the building. So what do? Well, the best thing to do is to go to the property evaluation and see how much the city allocates to the land and the property. The numbers are irrelevant. All you care about is the ratio. So if you're buying a property for $200,000 and the city's valued it at $150,000, but 25% of the value is allocated to the land, then you can take 25% of the value and allocate it to the land here as well, and go on that basis. That's one of the methodologies that we use. How much depreciation? Well, 4% or 2% the first year and then 4% declining. But what about if you have capital additions? What if you've done renovations? What kind of renovations have you done? Should all the renovations be added on as cost of the building, depreciated at that same percentage? Or can you pick and choose what depreciation rate you have based on the nature of the renovations? So if you change the brick on a property compared to changing something which has a useful life of, say, let's say 5 or 10 years, are you forced to put the renovation at the 4% rate? No, absolutely not. You can choose the rate that's applicable, but that means that you need to know what the rates are and how to qualify different types of renovations for those rates. Ultimately, it'll work out to the same thing, because by the time you sell the property, you'll either recapture the depreciation you have, or you'll never have taken depreciation and you just have a lower capital gain. But my view is that while we're doing these taxes, we want to keep your current income tax bill as low as possible, because the idea is keep as much money in your pocket as you can. So we use the tax rules to affect a lower taxable income, to give you less taxes, more money in your pocket that you can reinvest in real estate or do what you want to do with. So in essence, when you're faced with a decision of depreciation, you've got to take a look at all of the factors. An interesting thing in Canada is that you cannot use depreciation to create a loss. So if, for example, you have substantial expenses in one year, then you may not want to take depreciation, because you want to save that depreciation for the future. What if you have multiple properties? Does it mean that each property is a standalone and you can only take depreciation to create a net income of zero per property? Or is it the accumulation of all the properties that are considered to determine what the depreciation threshold is? In fact, it's all the properties that are considered to determine how much total depreciation you could take. So one of the decisions we always look at is, if a client has multiple properties, we take a look and say, which properties does the client think they're going to sell in the near future versus hold long term? Obviously, given the present value of money, I would rather take depreciation on a property that's going to be held long term, because I don't have to worry about that depreciation for a very long time. So in essence, What's the basic rule in depreciation? Take it if you can, but have a professional look at your tax return to see if in your specific instance it's something that's warranted, and if so, how much you should take. I hope you enjoyed this short little presentation. As I said, every week we're going to come out with something new and something different. Please keep giving your ideas on the website, on the Facebook page. Let us know what you want to know, and it'll be my pleasure to be able to educate you. Now, if anybody has a specific situation that they'd like to discuss, you can reach out to me through Messenger or reach out to my office, and we can set up a consultation for you to be able to go through your situation. Please understand that when somebody calls for a consultation, the consultation is chargeable, but if we're engaged to do the work afterwards, we will credit some or all of that consultation towards that work. That makes it fair for everybody. So if you just wanted information, you pay for it and it's yours to do with as you wish. And if you end up doing work, well, that information gets applied to the work, and so you benefit from the savings. Have a great day, everybody, and enjoy your weekend.